Gone are the days of thinking the market only moves in an uptrend and a downtrend. This is a basic understanding of structure. There are, and has always been, 3 market structures. Each structure creates the next. If you know RIMC, you have a massive advantage in understanding each market structure. Make sure you guys stick around to the end of the video. I'll be giving you rules to understand exactly which structure we are in. Before we get into this video, what does knowing this knowledge give you? Decision making is really key in trading. We're really good decision makers and we need to make consistent decisions over and over again. So understanding the structure we are in gives you key information on when to make decisions and, most importantly, where to make the decisions on the price chart. Knowing the current structure of the market will instantly put your eyes to the highest probability locations on the chart, and that means you're always trading in high probability locations, which makes you profitable. Don't expect to watch this video once and understand everything. It takes patience, dedication, and experience to truly understand this concept. But this is one of those concepts you have to know to become profitable and build an exceptional chart IQ. So here it is. This is the market cheat code. I'm going to give you simple rules to follow to understand which structure we are in. Each rule cancels out the other, so you will always know how to read the current structure. We'll start with initiations. So the identification of initiations is aggressive buying and aggressive selling. This creates imbalance across multiple time frames. Another identification is we don't pull back to 50% in an A to B price range. We just create new ranges and see continuation. This structure comes from sideways ranges or from RIMC points of mitigation for continuation phases. These are the highest probability times to trade this structure. These are the only structures where buying high or selling low is okay. So what I'm going to do now is I'm just going to identify all of the initiations that I can see in the market. These are all the times that we've seen aggressive buying or aggressive selling within the market. We can see that in all of these examples, we have created imbalance through buying aggressively or selling aggressively within the market. That's one of our identifications. In those aggressive buying or selling phases, we can also see that we haven't had any deep pullbacks. And that's really important to understand because that's how you're going to understand the difference between an initiation and a trend. This is a 12-hour chart now. So if we was to look on a lower time frame, and we look in these initiation phases, we can see that we have new sideways ranges being created on the lower time frame, followed by continuations to the downside. We can see between the candles here, representations of sideways ranges. What's happening when we get those higher time frame initiation phases, on the lower time frames, we're going to see initiation, sideways range, initiation, sideways range, and initiation. And what's happening here is prices creating new sideways ranges and just initiating lower prices within the market. That's creating future reaction points within the market as well. And they're aggressively selling within the market because they're initiating on the higher time frame. So that's the first part of initiations. It's all about identification. As we move through these next structures, you'll start to see how they all line up together so that you can get a full picture perspective and you can understand exactly the structure that we're in. So let's move on to number 2. This next structure, traders find the most difficult to read, but knowing this structure and how to trade it means that you can get involved before the big moves happen. Sideways ranges is where the intention for initiation is created. If we break down a sideways ranging market and we think about price location, the best locations to get involved are at the edges and after the swings are taken into a point of higher time frame mitigation. After every sideways range, the next phase of price is always the initiation. So how do we identify a sideways range? We're looking for those slow sideways movements where quote unquote lower volume candles are being presented. These are not going to be those low volume candles, but that's exactly what they look like. It's price contained between a high and a low point. And if you can't read the sideways range yet, that's absolutely fine. Look for the initiation, go back, find the lowest point and the highest point before the initiation to the upside or to the downside. So what I'll do is I'll just identify all of the sideways ranges on the chart now, where price is contained between a high point and a low point before price is broken out either to the upside or to the downside. So you can visually see where price is contained and the sort of price delivery that we get when we are contained. So this is the identification of a sideways range. We can very clearly see there's a lot of low volume candles. There's no aggressive buying or aggressive selling happening, and price is being contained between a high and a low point. This is where all of the high volume areas are. Just because we've got quote unquote low volume candles, that doesn't mean that these are low volume areas. These are the highest volume areas on the chart. And we know that because when price comes back into these areas in the future, this is where we're seeing reactions happening from these areas. Now, just to prove this as well, we've got the fixed volume tool. So what I'll do is I'll put it onto the highest point, the lowest point, and the initiation high. So you can see where all of the volume is created in the market. So you see here, we have a ton of volume inside the sideways range. This is where all the orders are being created. You see the breakout candle where most people would think that that is where the highest volume is. That is actually the lowest volume in the market. So we're always looking for the areas with the highest volume. I'll do another example as well. You can see here inside the sideways range, this is where all the volume is created. The breakout or the initiation, you can see that this is where the lowest volume is created in the market. We always want to be trading from locations with the highest amount of volume, because that's where we know that the price has to react from in the future. See here again, one more example. We have a load of volume inside the sideways range. When we break out, we see we have a lot less volume in the chart. So it's really important to understand how to read sideways ranges for two reasons. First of all, we know that this is where price has to react from in the future. And second of all, the next phase of price or the next structure of price after we see a sideways range has to be an initiation phase. So once you can identify a sideways range happening in the moment, which we have very clear rules for, and you enter at the best locations using the location tool, this is where you can get involved in the biggest moves in the market. Now, the final structure in the market, this is trend. This is higher highs and higher lows being printed within the market. Of course, everyone knows what a trend is: a low, a higher low, and a higher high being printed in the market. So I'll draw all of those on now. High, low, higher high, higher low, higher high. Then we get a low, high, lower low, lower high, so on and so on. Everyone knows how to read a trend. This is the most basic understanding of reading structure within the market. Now, something that's really important to understand about a trend is we are not in a trend until we get a higher low and a higher high in a bullish trend, and we're not in a bearish trend until we get a lower high and a lower low printed. That is really important to understand, because that's how you're going to differentiate between an initiation structure and a trending structure. For example, one of the rules that I said previously was when we are in an initiation structure, we will not pull back to 50%. So you see here between this low point and this high point, price is initiating higher and creating new sideways ranges and seeing continuation, a new sideways range and a continuation. And we haven't pulled back to 50% in this A to B leg until we get that initiation back down. That's how you can easily identify the price range within the market as well. And you can make sure that you're trading at good locations within the price range. Another example is here, between this high and this low point here, we can see that price does not pull back into the 50% of the A to B price range. Here, what do? We create a new sideways range here, and we see continuation. This is showing that this is all initiation structure within the market. It's a very clear identification of when to understand where we're in initiation and when we're in a sideways range. See here again, we get a bullish initiation. Price doesn't pull back to the 50% of this A to B price range. This is an A, this is a B. We don't pull back into the 50%. What do? We create a new sideways range and we see continuation. This is initiation structure within the market. That's how we can clearly identify where the swing points are within the market as well. When we do get those 50% pullbacks within the market, you see here we get a high and a low printed within the market, and we get that pullback into 50%. This is now where we're moving into a trending market. We're getting A to B price ranges that break structure, and they're pulling back into the 50% area. This is when we're in a trending market. You see here as well, we get a low point to the high point. That's a bullish initiation, but when we start to pull back into the 50% area, we start to move into a trending market. It's really important to understand the difference between a trending market and an initiation market, because that's going to determine the decisions that you make in the moment. So I've put all of these back on now so you can see the different structures within the market. You can see after every sideways range becomes an initiation. At points of mitigation, we anticipate initiation phases as well. And these are the high volume areas price has to react out from in the future. You can see every time price comes back into a sideways range, we're seeing a reaction. So let's just recap. Initiations are very aggressive buying or very aggressive selling. They happen after we break out of sideways ranges or at points of mitigation from an RIMC mitigation. That's when we typically see initiation phases within the market. Sideways ranges are where price is contained between a high point and a low point. This is where new orders are being created in the market. This is where volume is being created in the market. And the best locations to trade from a sideways range will always be the edges and after the swings are taken out. Then we have trends. We're only in a trend when we create an A to B that pulls back to at least 50% of the price range. That's where we get those nice A to B swings, pullbacks, and we can play those continuations. When we don't pull back to 50%, but we see a range and a continuation, that is still an initiation structure happening within the market. So now it's about going to train your eyes to see these price deliveries. These are fractal. These happen on every single time frame. Understanding market structure is probably one of the most important aspects of taking trades at good locations. Make sure you leave us a comment down below if you enjoyed this video, and we'll catch you on the next video.